Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Unleash the dogs of war. Buy gold, buy oil, buy treasuries, sell stocks. We're going to war, sell stocks. Are you scared? Are you selling? What's price telling you? You might just be surprised. Flight to quality? Gold popped. Notice I didn't mention Bitcoin. We'll get to that a little bit later. Oftentimes, folks, when the war is announced, it's actually announced, it calls a market bottom and the market rallies. Now here we're not really at a market bottom necessarily, but we could get a strong rally. It happens very often. But we'll get to the market soon and what price is actually telling us, not what the media and the headlines are telling us, which will cause you to lose money and sleep at night. But I want to touch on something that's a sore spot, a hot button, a thorn in my side, a raw nerve, and my personal favorite, a stick in my craw. And that is, well, sorry. Zach's laughing, sorry. That is a stick in my craw. And that is Wall Street's fascination with this price compression and margin squeezes on their management fees. That's all they're talking about. They're talking about low cost. You got to have low cost. Why? Why is that so important? I want to change the focus. Let's not specifically worry about low fees. Let's talk about returns, or let's talk about fees and returns. It's all about the net to you after my fees and your taxes or any advisor fees. If you're doing it yourself, you need to manage it. You need your hours takes a lot of work. What is the opportunity cost for that? And actually, how good of a job are you doing? Because just a differential of 2, 3, 4% a year over the long term can be hundreds of thousands of dollars. Anywho, so why must Wall Street, why do they focus on the management fee, the low fee structure versus their returns, right? Well, it's kind of like the 4% rule. I'll get to that in a second. But the bottom line is, if they're only making 5, 6% annualized, maybe 7, 8 if you're lucky, but let's call it 7, right? Or 6. If that's a 1% management fee or higher, that's almost 20% of the return. If it's gross, if it's gross, and if it's net, it could be 16, 15%. However, if you're making 2.5 times that, you're making low double-digit returns. Would you pay a differential of 80 basis points, 0.8%, or even 1? If your low cost pie charts or us is only costing you 0.1% and we're charging 1.2, but you're making 5 or 6 or 7 over there and going through 35% drawdowns every 5 years, or making higher returns with much less drawdowns, I think that's a very good value. But that's me. And then remember I told you about that hundreds of thousands you left on the table because of differential? That's also why Wall Street came up with this 4% rule in planning at the end. So you take out 4% of your principal in retirement, take out 4% of the account value every year, and you'll never run out of money. Well, and you make 6 or 7%, you don't have enough money to take out more to where you got to take out just a little bit so you don't run out. If you have hundreds of thousands of dollars more at the end of the day, guess what? You might be able to take out more money. But again, that's why I'm asking, and that's why they make you limit your money in retirement. Look, your diversified portfolio won't allow you to take out more without growing broke, but that's why they're talking about that. Okay? Now, so as a active manager, we're actually thinking about increasing our management fees next year. If our success continues, we may actually raise our price. Current clients be grandfathered in, but this is all about value. But look, if you are getting a pie chart to Russ portfolio, target date fund, asset allocation, 60-40 balanced fund, or some random rebalancing, if that's what you're getting, you should only be paying 0.1 or 10, 20 basis points, because you can do that yourself. I can show you how to do that free in 20 minutes. Hell, AI can do it for you in 2. You do not need a manager if you're doing pie charts or Russ. There's not a whole lot to manage. Now, that's my opinion. Now, the problem with that is you're going to make 7%, even though they compare to the S&P. Nobody ever has just the S&P. They'll give you some emerging markets or whatever, right? But you're going to get stuck with that pie chart or Russ portfolio, and you have to go down 35% every 5 years. And as my beautiful Southern, actually Texas wife would say, bless your heart. All right. Now, I want to take it a step further, because it's not just about the Wall Street pie charts or Us versus active management and what we do when we move up and, in and out of stocks. In other words, you don't buy rotten fruit for a balanced diet. Don always says that. We're not going to buy rotten stocks, right, to have a diversified portfolio. So let me ask you a question. So emerging, one of the show notes, Goonlock says foreign equities, it's time to buy foreign equities. We told you that a couple months ago. But for the last 25 years, they have been a dog. They haven't done anything. Anything that's trending down adds risk to your portfolio. If it's losing money, it's adding risk. I don't care if okay? So those emerging markets that you had as a sliver of your pie chart actually reduced your return and therefore increasing your risk, because if you make more money, you can bank more money. You need less later, right? You can actually get more conservative if you want to. We'll dial up and down the risk on a daily basis, all right? Anyway, if you had emerging markets or any international for the last 20, 25 years, that was, if it's like an index fund or they lost money. They did not make money. And the American markets were a lot stronger. So you shouldn't have any, pretty much. I mean, maybe a few individual stocks, but not the sectors, not the emerging market funds or the Europe and Japan funds. They weren't doing better than America. That's why relative strength is so important. Okay, now I've drawn the dichotomy between pie charts or Us, which is pretty much all of Wall Street, the sell side for sure. Okay, and what Revere does, and there are a few other active managers, but they're far and few in between. But there's advisors that call themselves a fiduciary. We're a fiduciary. We only charge you a flat fee, and there's no conflicts of interest. And it's even better. We're buying the exact same stocks, the exact same price. Don and I and the people, the employees of the firm, they're in these strategies at the same time as you are. You're getting the same price as us, the same performance, the same positions, right? But the fiduciary model versus a brokerage model where they're charging commissions and there's a conflict of interest. We don't have any conflicts of interest. But that's not most important. Most important is strategy. You need good strategy. It's not enough just to be a fiduciary. I mean, I hear it all the time. There's one fiduciary here in DFW going, oh, you can get a 25, 30% bonus on your money. He's talking about an annuity it's not a commission annuity, but it's an annuity. Folks, you're not getting a 30% bonus. That's if you annuitize it for life and you give them $400,000 and they give you $2,000 a month or based on your life expectancy. Well, instead of giving you $2,000 a month, they give you $2,100 a month. So that rate of return, instead of being 4.8, is 5.1 on your money that you gave to them. And now the lump sum is gone. They're giving you income for life. That's the 20, 30% bonus. So this fiduciary here in Dallas is using these no-load annuities because he's not actively managing money. I think you could do a lot better this way. That's my opinion. Now, there's another advisor. One in particular has all kinds of TV ads. If you've got over $500,000, when we do better, you do better. Well, that's true with us, right? We've gotten a couple clients from him in the past few years, especially during the inflation COVID bear, the 2022 COVID bear. Both of those two people, they had 50 positions at 2% each. 50 positions, 2% each, and there you go. You're just buying an S&P 500 fund. You're tracking the S&P whether you know it or not. You might as well just do one trade instead of 50 and lower your, or couple ETFs to lower your cost. But then they let it ride. They don't have a sell discipline. You don't believe me and you're a client of theirs, ask them what their sell discipline is and ask them specifically. You call Revere, we can give you our quote stop, our sell spot on every single security in the portfolio. And then what the total portfolio drawdown would be in a given day if we really hit the fan and the whole market started going. If we went completely to clash, would that be 2%, 3%? What is our Revere estimated balance at risk? Okay. So not only do we have sell rules for every single individual position in the portfolio and watching the intercorrelations between those positions, we also got kind of a stop for the entire portfolio. So when I turn it over to Don and the team, what I want to know is your advisor, and if it's you or you, thinking like this and doing this kind of work? See, we're making market-like returns, but with breaks, okay? We've got breaks. It's a better way to drive with gas and brakes so you don't get T-boned by the S&P or the NASDAQ in the next bear market. So with that, and so you're not Wall Street's diversifier, so they can stick you in an emerging market for 20 years as a dog and treat you that way. A better way. Don?
Got it, Dan. A better way. All right. So here's.
Yeah, don't embarrass me now, Don. You got to bring it, baby. Bring it.
Well, it's a challenge there, Dan. So I might accept that. So here we go. S&P 500. This candle looks really like nothing, and really, overnight was when the fireworks started. Metaphorically for the market, literally if you're near one of the nuclear facilities in Iran. But when I did Thursday's video, none of this had started, and I mentioned two levels. I mentioned how we had been bouncing around the 6,000 level for the prior 5 sessions. For the 3 sessions before, 6,000 had been acting as support for the S&P 500. So when the news hit the wire about Israel attacking Iran, we gapped down. I also mentioned a secondary area of support that was of interest, and that is the low of 6.5. This was the last stress day of the S&P 500. We bounced right at the 8-day moving average, and I also mentioned that the green line, the 21-day moving average, would be coming up to meet that level on Friday. So overnight, although it looked pretty bad at some points with a gap down of 1.7, 1.8%, all we did is come down to this level, which was the overnight low was 59.24. So right at that low of the secondary support point and right into the 21-day moving average. By the time the markets opened this morning, that loss of 1.8% had been cut in half. We opened down about 0.9% on the S&P 500, sold off a little bit, but now we've regained that key 6,000 level. This is just bulls being bulls. This is what happens in a bullish market as opposed to a bearish market. And there we get a nice little upside alert as we're discussing it. It's like the markets are helping me out here. If you have a pie chart advisor, you couldn't be concerned because they weren't going to do anything anyway. If you were worried, it didn't matter because they were just going to sit there and not change their tea time.
It's Friday, Don. It's Friday. They're playing golf.
And really no care whatsoever because they still get their fee regardless of what the balance is on your account. But if you're at Revere, you're exchanging texts, you're mentioning fib levels, you're mentioning support levels. This is going on all with the technical team last night. We wake up this morning, we have our 9 o'clock meeting and go around the horn, talk about all the possible entry points for everything. And I mentioned this was actually a pretty good risk reward to add to the SSO position that we started yesterday with that bounce off the 6,000 level. So we did in fact do that, add more SSO early in the day, and that's profitable now as well. Until this low, which was on 6.5, the last shakeout day, which now corresponds to the 21-day moving average. I'm talking specifically about now 59.25 on the 21-day moving average, and it's moving up about 10 points a day, 10 to 12 points a day. We're just riding this wave higher, and we'll stay invested in the indexes as long as that continues to happen. As far as leading stocks, they haven't been acting as well as the indexes over the past week and a half, 2 weeks. Prior to that, what we saw is the majority of our gains were coming from the leading names that we held. A lot of them got extended. Very normal for them to go sideways or pull back into support levels. But what we've seen over the last week is that new positions really hadn't been gaining much traction. There's always outliers or some that continue to work, but hadn't been making much progress. And this corresponded with a slight move higher in relative strength on the indexes compared to the leaders that we had in our portfolios. But the bottom line is, Dan mentioned REBAR, Revere Estimated Balance at Risk. We keep that every day. That's also something that keeps us from overreacting when negative news hits the tape, because we already have our stops all pre-assigned to every position, and we know what the drawdown in the portfolio is going to be. That drawdown corresponds to technical damage on the individual names or the indexes, and it's a common sense way to measure your risk and determine what defensive actions you're going to take at predefined levels. And it also helps us and our clients sleep well at night, knowing that their downside is protected. So what do we do now? It looks like that this 1.82% overnight gap down in the indexes has been bought. Now we just monitor our levels. Right now, that 59.25 and rising is key level in the 21-day moving average. We really won't get much more defensive until we start to break that level. However, individual stocks have their own personality, and we did get stopped on Bros this morning with a gap down below the 21-day moving average. It was down as much as 7% at one time. We did several sells to get out of this position. We just don't like holding things that are below the 21-day moving average unless we have large gains in them. This ended up being, and sometimes it shows on the chart before, a precursor for what's going to happen. What we saw was a failed breakout from this really nice cup and handle base. And relative strength lagging over the past 4 weeks, like I mentioned, with a bunch of leaders. Bros is certainly one of them, but I cut the position from grow according to our pre-designed plan, break below the 21-day moving average, so it's out of the portfolio. Now we monitor for something to take its place, something that's continuing to act well, or a standout in the portfolio that we can add to, like Palantir, which bounced right off the 8-day moving average, was down pre-market, is now up 2.8% on the day.
That looks like a cup and handle too, right there, doesn't it? Or is that
it
a
is,
handle?
and it's one that, yeah, and it initially broke out or attempted to, but never made. You can just look at the relative strength line. This hadn't made a lot of progress relative to what the S&P has been doing until today. It kind of hooked its head out from that level. And you also had a big shakeout on 6.5 on Palantir as well. We got stopped out on some shares below the 21-day moving average on that as well. But this is very clearly one of the leaders. But normally I stick to the overall market when I do my segment. And for now, the NASDAQ 100 also undercut reclaim of the 8-day moving average. The fly in the ointment continues to be the Russell 2000 small caps, which ran into the flat 200-day moving average on Wednesday. And this actually was a pretty good attempt to short it now. But since then, we've just pulled back to the pivot of this little multi-week base that it formed. And this, if it's a short up here, it's not a short down here, because now you're down to the support level. And you can see it hit the top of that base above the 21-day moving average. And this is actually a low risk shot to take a long here using the 21-day moving average as a stop. It should continue to hold out on the way up. See what happens if it gets up and approaches the 200-day moving average again. Obviously, bulls and the long-suffering holders of small caps are hoping that this busts out. We don't hope here at Revere. We follow stats, charts, relative strength, what's actually going on here. And if it does break out, that certainly portends higher prices for the broad market as well, because that would indicate risk on is definitely here. So that's actually the third key that I put when I did the video. We've got keys coming into every day, what would make us change our thoughts on the market. The two keys were support levels on the S&P and the NASDAQ 100, and the third one was what's the Russell doing relative to the 200-day moving average. So that's something we'll keep an eye on next week as well. So that's the high-level look at the markets. Bad news, what was seen as bad news. There's also a saying, an old Wall Street saying that says, buy the cannons, sell the trumpets, which means buy the beginning of war, sell when the war is over, or be prepared to. But this is, we're near highs of the day right now, down 0.4%. It looks like just another day in the market where if you hadn't been paying attention to the news, you wouldn't really think anything about what's going on. So any questions about that, Dan, or any?
No, and I just want to make one more point. So remember I was telling you that emerging markets and international's been dog for literally 20, 25 years. So in real time right now in the U.S., large cap and that, NASDAQ and S&P stocks are stronger than the Russell small caps. And so you shouldn't be putting, maybe now you are getting an entry point like he was saying, and that's timely. That's why it's important. So if smalls are not stronger than bigs, you're taking more risk for the smalls. You shouldn't own them while they're riskier. Now, once that changes and the relative strength starts to hook up and people start buying, accumulating them, then the risk profile of the security changes. It's the risk profile of the market, the sector, the stock itself. It's not your risk profile. All right. Who's up, Don?
Well, we're going to send it over to Todd, and timely segment, oil. Oil spiked overnight with the Israel attack on Iran. There had been a couple of nice oil names setting up, and Todd's going to go through them. Take it away, Todd.
All right, Don. Basically, all these stocks are trading close to all-time highs and have been in very tight weekly basis. The first one is Range Resources. And Don, if you go to the weekly chart on Range Resources, it has quite a few bases going back several years to 2022. And just has never been able to break out here, but you can see that relative strength is rising nicely on this particular one. And the other thing that's pretty attractive on this is if you go down to the earnings and sales growth on every one of these stocks in market surge, you can see there are substantial sales and earnings growth coming on every one of these names. So these are all very nice turnaround plays, very close to all-time high. And Range Resources is a producer of gas and oil. And again, this is the first one I want to talk about that's very close to clearing all-time highs of this multi-year base-on-base patterns. On the second one, I believe, is EQT. And if you look at again, you can see on the daily chart how tight this is. But if you go to the weekly chart, again, this has basically a 6-week tight on the weekly chart. And again, if you look at the weekly, it's just been super tight, 6 weeks tight, right up here against all-time highs. And this is the largest, actually, natural gas producer in the United States. And again, looking at those earnings and sales, huge turnaround play with relative strength rising nicely, just sitting up here at all-time highs. The next one Don, is Range Resources.
Yeah, you mean Antero. We already did Range.
Or Antero, sorry. Again, another one which just broke kind of the trend line here a few days ago of it's a nice cup with handle base. Looking at the weekly chart again on this. You've got a really nice series of numbers coming up on this as well. Everyone I selected here has very strong triple-digit growth coming ahead. And again, not the tightness that EQT has, but also very strong and pushing up against multi-year highs. And finally, let's talk about EXE. Now, again, I want to focus on the weekly charts on all of these just because they're so tight and the earnings. And EQT is another one that's showing a 6-week tight. Little bit of a shakedown this week to the 10-week moving average, but again, trading extremely tight. This particular company, along with EQT, those are the two largest natural gas producers in the United States. And this company was formed on the merger of Chesapeake. So it's a merger of the old Chesapeake Energy as well as Southwestern Energy. So this is a very large company. And so these are very good quality names, all trading very tightly toward the highs, all pushing multi-year highs or all-time highs. And out of all of them, I believe EXE is the only one that's really kind of been in all-time high territory here. So these are just some alternative names during this time with the potential for the Middle East situation to kick up and could be a nice alternative for your portfolio.
Notice on every one of these, when we went to the weekly chart, I was able to draw an uptrending line on the relative strength line. And that's just saying that these four names all outperform the broad market throughout from like mid 2024 through where we are now in 2025. Energy has not been getting a lot of play, and the reason for that is that the ETF that represents the energy sector in the S&P 500 is XLE. This is primarily made up of Chevron and Exxon, and look at the relative strength on XLE. It's terrible. The setup on this is terrible compared to those four names that Todd just presented. And that's something to absolutely pay attention to. If Chevron, let's take a look at the individual names. Well, CVX first, CVX, not CVS. CVX, big drop here down in April. Oil's got taken to the woodshed, and it's the headline names like Chevron and Exxon that make all of the headlines, but it's the names that Todd just pointed out that when you get them, you can make money in. And you can see Exxon and Chevron now having a great last week of performance, but they're just playing catch up compared to those four leaders that Todd presented. Nice job there, Todd. Let's move on to Connor's going to give an example of sometimes your first buy doesn't work on a name. You got to be patient. You got to obey your stops in case it doesn't turn around. But when it does, you can't be afraid to get back in. So he's going to talk about Tempus, ticker TEM.
Yep. So the main theme of the segment today is don't be afraid to buy something back after getting stopped out. And I'm going to give an example in the TurboTection portfolio. And just to kind of before I get into the trade on TEM is that timing is very, very important in trading and investing. And sometimes you just simply get the timing wrong, although the thesis might still be good, but maybe you're buying a little bit too early. The stock's not ready yet. And this happens all the time. It's impossible to be right every time you buy something. So sometimes if you buy something and get stopped out, you never want to take your eye off it because, like I just mentioned, you could have just got the timing wrong, but the thesis still stands. So Tempus AI is a really good example of this. May 27th, we bought a position in Turbotection, and you can see had been tracking this name for quite some time, looked ready. It bounced off the 21 day, and then it gapped up and followed through the following day, closed near the highs of the day. It was looking quite well, and then got unlucky the following day. It got hit pretty hard. There was a short report out by Spruce Point, and it really just gap below our stop. And we don't argue with price, and that day closed down on pretty big volume. Although the short report didn't have much substance to it, but again, price is truth, and it broke the stop. And then the following 3 days, that actually marked the low. And then as it started to come back up, it was still on the radar. And then in Turbotection, we bought this on the 9th, June 9th. And this one's starting to work again. So although, getting stopped was the low, to us, that doesn't matter, because this could have gone way lower. You just really never know. And that's why hindsight always looks 20/20. Managing risk in real time is a lot harder. But for now, the re-entry on this one's working. And I think just people that get stopped out on things, they struggle to buy back because they don't think it will work the following time. But sometimes you're on a monster, you just have the timing wrong. So it's important to train that muscle that it's okay to buy back. People do it all the time. William O'Neill did it all the time. If you read any of his work, is that he said, he would get stopped out, buy something back. That's just the nature of trading and timing your buys. So could get stopped out on this one again, but for now it's looking pretty good. 72 is a big pivot that we were watching, and it's holding above that for now, up slightly on the day in a relatively weak market. And as this continues higher, we'll just continue to raise the stop up. But this one looks good, and glad we bought back in.
So to clarify, when you say monster, he means a monster stock, like a big gainer. He doesn't mean like ugly monster, a Frankenstein, like something you want to avoid. He means a monster gain, so you want to get back in. That's a great gold nugget, Connor.
Exactly.
And look at the entry that these guys made here on this break of the downtrend line with power. Excellent entry. Can't argue with that. Just bad luck the next day on that short report. Another break of the downtrend line with the re-entry, and this one's working. And notice the increase in, I'm going to say, not earnings per share, but the loss of earnings per share, how it's going down, and they're basically break even for 2026. Meanwhile, they've got very large sales growth, up 75% in the most recent quarter compared to 36, 33, and 25 in the 2 quarters before that. So definitely has the fundamental characteristics for leadership. Also, Ant showing up here, meaning it was up 12 out of 15 days. So that short report was just completely shaken off. And this looks like it wants to go higher.
And I want to mention one thing. So, folks, this is how we manage risk. So we got in on a good entry. It started not working. We got out. Then it started working again. We got in, and if it keeps working, we'll let it run. So you're managing risk because, look, you don't know that it was going to snap back. See, you're looking at that chart right now going, oh, well, yeah, it was fine. You didn't have to sell. But it could have gone down another 20%. You don't know that in hindsight. One of the things Bill O'Neill also used to say is anybody can read the left side of the chart, meaning it's already happened, hindsight, rearview mirror. But it's interpreting the potential right side of the chart that hasn't been made yet. That's the real, and the probabilities, that's the real talent.
All right, good stuff. Let's take it over to Ted. I know you're going to be surprised to hear that Ted's going to be talking crypto today, but that's what we're doing. Take it away, Ted.
Going off Connor's section, I wanted to talk about how even within a trade, you can get stopped out of a partial position and then you put it back on as well. So you can keep a core position in names and trade again, like trade around that core position as well. And that's kind of what we've done in Bitcoin over the last couple months and Ethereum. We're going to talk about a winner and a winner of part of the leg of the trade, and then a recent loser as well. So we initially initiated a position in Bitcoin here, quarter size position of 2.5%. And what we saw was during the market crash, and I've already talked about this multiple times, we saw this hold the 74,000 level, which was the pre-election breakout. So that respected that price structure. And while the indexes went on to crater more, Bitcoin quickly undercut and reclaimed the 74,000 level. So immediately that put a signal for us to start stocking Bitcoin. And even better, it got extremely tight. This range was literally 3.5%. And for Bitcoin, that's extremely narrow and tight. You see the 8, 21, and 50 converge as well, and that's called the power of 3 setup. You break through that super tight flag, and that's where we initiate the position. And then somewhere up here, we added on to the position right here into this breakout above 100,000, and that ran into 100,000, hold back, rejected. And once we saw that, it held the 50. We decided to double the position to a full size around 106,300. And this is the part of the leg of the trade that is a little underwater right now, barely by anything, but earlier today it was underwater more. And we held the 50-day perfectly. And our expectation was that this would take off, but we did potentially see some resistance at this left side peak. And with the war news, that kind of dragged down Bitcoin a little bit. But the positive side is it continues to build higher lows. This was a low here, higher low up here against the 50-day moving average. And now we're pretty much back to our average for the second part of the trade. So currently that is a loser, but it's looking good now. Potentially might turn back into a winner soon. And of course, the buys down here are deep in the money. On the losing side,
big winners. Yeah, the first two buys are big winners. It's just that last leg that's underwater.
Yeah, a loss that we did take today was our Ethereum ad. I just want to first review our initial buy and just our thought process around Ethereum. So Ethereum was in a stage 4 downtrend, and we've talked about stage analysis multiple times. So I assume the audience, you guys are familiar with 4 stages. Ethereum was in a stage 4 decline for about 6 to 8 months, and it got extended from the longer term moving averages. And kind of a term I coined was like a price gap. And so that presents a quick mean reversion trade, which we took on May 1st. Kind of consolidated for a little bit, almost shook us out, but it held our stop of around 1720, 1730. And this gave us a quick 3-day burst. We decided to sell 75% of the position into the 150-day moving average. And that pretty much in our minds was the completion of the trade. But since that was so powerful and, to be honest, unexpected in terms of the power and velocity of the breakout, we wanted to hold on to 25% of the position. And since we already took 75% off, we were able to give it a lot of room. So in our minds, we just set a break-even stop, mental stop. We just let this thing chop sideways for over a month. And over this breakout, it reclaimed the 200-day moving average on June 9th. And then it took out the whole number 2,800 level. So this is when we brought the position back to a 5% size, which was our original size. But it reversed, then it followed through, broke the 200. And today on the Israel-Iran news, it just hit our stop, which was around this low right here of about 2,500-ish. So it took us out. We trimmed back the position, but we still hold that trailing piece, which was 25% of the original position currently. And if this continues to set up, or if this was a shakeout, like Connor just talked about, we have no problem buying it back. And we've really begun training ourselves to not fear buying something back if it is properly set up. And just a good reminder in our heads is that each trade is an independent event. So each trade is an independent event, so the probabilities itself are independent. And if it is set up, you just have to forget the past of what happened and just buy it back.
Wise words. Wise words. Folks, listen, I did want to mention one thing real quick because we did get a MB sent an article, like I said, the Wall Street Journal, talking about the USD under pressure from gold as the reserve currency, whatever. Folks, gold rallied on this war news and Bitcoin and the crypto sold off. That doesn't, I'm not saying Bitcoin's bad. That's not what I'm saying. I'm saying price is telling us that people, when it's a fear trade, when they're scared, they still go to gold, and they still think gold is a little bit stronger than Bitcoin as a currency, as a safety, a flight to quality, a safe haven. It's not that Bitcoin won't make more money, or it's just like a tech stock. But most people still treat it like a investment tech stock, high beta thing. They don't see it as a indivisible store of value like gold is. I'm not saying Bitcoin isn't indivisible. That's the whole point. It's supposed to be the electronic gold. Well, I hope that server is always up and running, because if the server gets shut down, I don't know how good that electronic gold is. Anyway, the whole point is price, it's a little different. But today we had a pullback and gold held and was strong, and these other things were weak. But now it looks like the market's rallying. Don, before we go out, do you have anything to add, or what is the S&P doing? Is it green yet?
Not green yet, but headed that way. I just want to point out the entire crypto community is laughing at you for saying if the server shuts down, what's going to happen to crypto?
No, I know. They got backups and got all that stuff. I get all that. I get all that. Look, I'm not saying it's not. I'm not saying Bitcoin, they don't have redundancy and they don't have all that stuff. Look, folks. First of all, if these strong powers really have that much power, are they going to let the Bitcoin replace the U.S. dollar as the reserve currency without a fight, or until they're ready to allow it? Remember, we've gone to war over the USD. Okay, those in power aren't going to go gently in that sweet night. Now, I'm a big Bitcoin bug. I'm not anti-Bitcoin. I just treat it a little bit differently than gold. That's all. Any questions, comments? Bring them on. Anyway, anything else, Don?
Nope, that's it.
All right, folks. Well, listen, let's pray for peace. The dogs of war are going right now, but hopefully it'll be short-lived, and it'll be by next Monday, we'll have news of peace. That's what I'm hoping for. But regardless of which party's in power, regardless of the geopolitical events going on globally, price is truth, no exceptions, period. Every investment has to earn its way on our portfolio and our strategies, and then that investment has got to continue to earn its way on our portfolio. We don't pre-select stocks or products for you ever. If you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. They can put their name and email address in. This will go in their inbox Saturday morning, along with our daily market insights. We do a daily market insight video, 10, 15 minutes every day. Every evening, the market is open. We're the most transparent advisor, not only in the United States, in the planet that I'm aware of. Also, if you go to YouTube and just type in Revere Asset and hit subscribe, you'll get this podcast. Our stock nerds get it before the market close. Zach will have this on YouTube by about 12:30, 1 o'clock Central Time. And you can always call us old school at 855-REAL-WEALTH. Folks, don't get a pie charts or us portfolio from a stripmalladvisor.com. Learn a better way to invest. At Revere, price is truth, no exceptions. We'll talk to you next week on Your Money, not their money, your money.
Because it's not about how much you make in the markets, it's about how much you can